Pankaj Murarka is with us, CEO and CIO at Renaissance Investment Managers. Pankaj, thank you very much for joining us. Great to have you with us here on the program. Appreciate it. Last time we spoke, we were talking about what you like in this market. And one of the names which sort of remained with me was SBI, State Bank of India. So I just want to start with banks per se, because more and more, it's not recent, but more and more people are kind of veering to the idea that large banks, mostly private financials, and maybe an SBI, I mean, their time has come, will come, because, there is valuation comfort, etc. So just wanted your thoughts to begin with, and then we'll look at other sectors as well. Go on.
Morning, Prashant. Well, yeah, Prashant, from our point of view, we've been underweight banks for a very long time, almost 2 years, but now we are gradually closing underweight positions because we think probably we are in the last leg of cyclical slowdown in the loan growth. Probably we see loan growth picking up from next year onwards. And probably once we have few rate cuts in place, we'll see some initial margin pressures on banks for the next few quarters. But we don't see that as significant. And the fact remains that in a market which has moved pretty sharply over the last 18 months, banks is now one segment of the market where valuations are far more reasonable compared to the overall market or the broader market. And more importantly, asset quality for the banking sector seems fairly benign. Large banks are in a very sweet spot in the sense credit cost is extremely low or very benign, and growth is reasonable. And on top of that, as I said, valuations are pretty reasonable. So sum total of all of it, we are turning positive on banks, as you said, some of the larger private sector banks and including SBI as well. And but from our point of view, we as investors take a view which is slightly more medium term over the next few years. And from that point of view, banks certainly look much more attractive than some of the other pockets of the market at this point of time.
So to close out your underweight position, you're buying large private sector banks and State Bank of India. What about the other PSU banks? Are you looking to buy them?
Well, generally our portfolios are focused portfolios. We just have about 25-30 names. So in a particular sector, we can accommodate only 4 or 5 names. So we stick within the state-owned banks. Our preference is for SBI because SBI is far better in terms of qualitative metrics, be it ROEs or the risk-weighted assets versus some of the other banks. But I'm sure as we see traction coming back into banks, some of the other banks will follow SBI.
Hi, Pankaj. Good morning. Good to see you. And since we talk about banks, let's talk about a couple of other financials as well, like insurance. There was that hope that there's going to be a pullback in GST rate. That didn't come about. Some of these stocks have still not performed big time. Case in point being HDFC Life has been a relative underperformer. How are you placed on the life insurance companies?
Nigel, while we don't have in insurance companies, life insurance companies, but my view is the worst is behind the sector. The sector has had significant headwinds in the last 2 years. If you see, starting from the budget of last year, where there were some of the larger insurance payments were brought under the tax net, and then there's been a sharp reduction in the distribution payout on ULIPs and so on and so forth. But I think the sector has digested all of those headwinds, and we've started seeing some reasonably healthy growth in the sector over the last 2 quarters. So I think the fact that India's savings are accelerating and insurance is one of the prime medium for savings for large masses, apart from the coverage that it gives, I think from here on, insurance as a sector or some of these insurance companies will do well.
Pankaj, you'd also gone overweight on IT a couple of months back. Now that trade seems to have played out because in a span of 3 months, it's given pretty good returns. What is the call now on technology? Are you still overweight? Would you look to pare it down, increase your overweight?
No, Rima, actually, that's a slightly more longer-term call. So as you rightly said, we've been overweight IT, some of the larger names like Infosys and Tech Mahindra among the larger names, and we have exposure to some of the Midcap names, including Birlasoft, Persistent, and Coforge. And we think that we are in the early stages. While stock prices have moved in the last few months, we think more importantly, what we are really looking forward to is we're looking forward to a revival of IT spends over the last 18 months because of rising rates in US. A lot of discretionary projects and spends have been held back. And we think once US gets into a rate cut cycle, starting probably towards 3rd week of this year, when we get the first rate cut in US, there's a lot of pent-up spend that is there amongst the, let's say, the Fortune 500 and the Fortune 2000 companies globally. And these companies can't hold back spends for a long period of time. So we think now once you get rate cuts in US, IT spends in US will come back very sharply and very strongly. Because for Global 2000 or the Fortune 2000 companies, it's a necessity. It's not a choice or a discretion. Any company not investing into technology, into adoption of AI and some of the other tools probably is risking its survival probably 10 years out, and which they can't afford to. So we see a very strong environment for, one, we see a gradual pickup in discretionary spends, and more importantly, the trend getting much more stronger as we move towards next year, probably in the second half of next year. So we remain constructive or positive on IT from a slightly more medium-term, longer-term perspective. Slightly more longer-term, my view is that the upcoming IT spend cycle that we're going to experience over the next 2 or 3 years probably will be much longer than that, than traditional IT cycles that we've seen in the past. And probably it could be one of the more ferocious IT cycles that we have seen in the last 25, 30 years. Because AI, remember, AI is the internet moment for the world. It is going to revolutionize and change the world, and enterprises will have to adopt and implement AI solutions at a very rapid pace. So we are slightly more bullish from a slightly more longer term perspective when it comes to IT as a sector.
You know, in that 25-30 stock portfolio, is it what's the leaning to large caps?
Generally, our portfolio is flexi-cap, Prashant, so we run about 50-60% large caps, and the balance is spread across a handful of mid caps and small caps. So,
do you own any with market caps of less than 15,000 crores?
Yeah, we do have some exposure, Prashant. But then when we're looking at smaller companies, obviously we're looking for companies, outstanding companies, which can, deliver very strong growth. And generally our endeavor is, when you're investing into small caps, you're looking at the small caps from a 5-year prism, where we actually think that the small caps over the next 5 years can actually transition to being a mid cap by virtue of consistent strong growth. Or when you're looking at mid caps, you're looking at companies which can change the orbit and probably transition from being a mid cap to a large cap over the next 5 to 7 years. So clearly, when you're looking at mid and small caps, you're looking at outstanding companies which can deliver very high growth on a sustained basis and change their orbit.
Why don't you talk us through one or two names, just to use an example, Pankaj? I mean, portfolios are disclosed, so nothing that you don't already own or are thinking of owning, and just how you're thinking about a name or two. Go on.
Sure. So in the capital goods space, we've had exposure to a few of these companies, which were actually mid caps 4 years back when this investment cycle started. Something like a Cummins or ABB, all of these companies were mid cap, and now you see the kind of fundamental performance and earnings growth, and also supported by stock price performance. Some of these companies have actually become large cap. So essentially, we like to buy companies slightly be ahead of the curve or ahead of the cycle, look at ideas from a 3 to 5 year perspective, and look at companies which can deliver outlier growth, and probably then be investing into these companies slightly ahead of the street, and then be a patient holder for the next 5 years or 7 years and reap those rewards or benefits, I may say so. So clearly, we own some of these attractive ideas on the NBFC, on the let's on financials on midcap NBFCs. One of our exposure is a company called Poonawalla Finance. We think, from a classical midcap, this company actually has all the potential to be a large cap over the next 5 years, because the company is looking at pretty aggressive growth of 40% CAGR over the next 5 years. They have a new management team in place, and probably if they execute well, probably in 5 years' time, it could potentially be a large cap.
Poonawalla FinCorp. Any other names? You've given us a stock in the adult category. Adult as in age-wise, young adult. What about in the kids category? Smaller name.
We own some small cap IT companies like Birlasoft. We think, again, they had a management change about 2 years back. The new CEO is fairly hands-on and pretty focused in driving strong growth. If you some of these mid-caps companies as they exist today, Persistent or Coforge, they've gone through a very strong growth cycle over the last 7 or 8 years. Birlasoft today is exactly where probably a Persistent or Coforge were 5 years back. You've got a new CEO who's run a very large business for Wipro. He used to run $7 billion P&L. Now he's running a company which is 1/10 of the size, and aspiration is to get company to a much bigger size over the next 5 or 7 years. the opportunity out there in IT services is significantly large, and we'll see many companies in IT services in India which will transition from mid-cap to large cap and probably from small cap to mid-cap. So we think Birlasoft is one of those companies which is under $1 billion of revenue and probably should cross the $1 billion revenue threshold probably in the next 2 to 3 years, and probably actually evolve as a mid-cap IT company over the next 5 years. And if it plays out, then probably I think there are very handsome returns for shareholders over the next 5 years in the company.
Oh, interesting. All right.
One regulatory disclosure before we go off is we have exposure to all of these companies, so investors should do their due diligence before acting on any of these.
All right. Interesting. Pankaj, final question, and just to help us lead into the next discussion, what's the view on auto ancillaries in particular? How you'll position there?
Well, again, we are very selective because valuations in that space are rich. The auto sector itself is going through a cyclical slowdown, and that has had a rub-off effect on some of these ancillary companies in terms of their growth moderating. And some of these companies have large exports where also things have slowed a bit, especially in Europe, and which is again having a rub-off effect on these companies. So one clearly have to look at companies which can, despite a cyclical slowdown, can deliver strong growth and probably have strong edge in terms of the product they have in the marketplace in that sense. So we are fairly selective in this sector. We do have exposures, but we are fairly selective.
Okay. Thank you very much for joining in.